It is becoming a top beneficiary of all the work going into diversifying the global chip supply chain. Let's talk about Japan specifically, because they have what we think have all the right ingredients to be possibly the biggest winner from, as you said, all of this friend-shoring and onshoring of chip making in the wake of the pandemic and the chip shortage.
Welcome back, everyone, to Chipstock Investor. Today, we're going to focus on a company that we have not done a deep dive in yet. It's the final company in the Fab Five that we have not fully talked about. Nick has talked about Tokyo Electron in some of his write-ups within the last year, but we've never done a full deep dive analysis on Tokyo Electron, and we need to do that. Why do we need to do that? Because Japan's chip manufacturing could become the biggest winner in the chips manufacturing race. Its importance in production of chips has steadily shrunk for decades, so you may be wondering why we're focusing on this right now. Taiwan semiconductor manufacturing has led Taiwan to the leader in making the most advanced chips. In fact, over 90% of the world's most advanced chips are made there, excluding memory chips. But these days, onshoring and friendshoring of chip fabrication plants or fabs are all the rage, as we've seen in various news reports over the last year. And Japan and its tool makers could be big winners.
So almost a year ago, I talked about Japan becoming an emerging leader in the semiconductor manufacturing race. The conversation at that time centered on Rapidus, which is a giant fab startup focusing on 2 nanometer chips. They're going to actually begin a test run starting in 2025. They've recently announced development agreements with Jim Keller, the famous chip designer, and his startup, Tenstorrent. And we've also talked about in recent videos TSMC's fabs in Japan. They just opened a new one in South Japan, and they announced an expansion there as well. So they've got these things up and running. Just to be clear, we're talking about Japan specifically in this episode, but make no mistake, TSMC is really going to be key for Japan's chip making aspirations. TSMC has massive firepower. They can spend $28 to $30 billion a year in CapEx to build these facilities. And that's in a pretty fairly conservative year to diversify their base of manufacturing outside of Taiwan. Plus, you add in all those government incentives in Japan, in Germany, possibly in the US. As of this recording, we're still waiting on CHIPS Act funding, as Taiwan Semi still makes that push to diversify its advanced chip making outside of its home base. We have this chart here that we've been using for a while showing their long-term goal. So TSMC will be a key part of Japan's story. And Southeast Asia at large will be as well. Singapore, Malaysia, even India getting in on the chip packaging party. But we'll talk about this another time in a different video. But let's talk about Japan specifically, because they have what we think have all the right ingredients to be possibly the biggest winner from, as you said, all of this friend-shoring and onshoring of chip making in the wake of pandemic and the chip shortage.
We don't need to repeat much of the same info that exists out there already. We will point you to an episode from one of our favorite channels, Asianometry, on why TSMC is expanding into Japan more successfully than it is in Arizona in the United States. It's a great episode. It's one of our favorite channels. If you want, you can go to that episode right now, watch it, and then come back and we'll start from that base level, macro level stuff already in place. And that's where we need to peel back some of the layers and find businesses of interest. And today, as we made clear at the outset, we'll focus on Tokyo Electron. And then later this week, we'll be discussing Renesas.
All right. So let's talk about Tokyo Electron's rise to fame, at least from the perspective of a North American investor. If you're in Japan or somewhere closer to Japan, you probably already know about Tokyo Electron because it is one of Japan's largest businesses. In fact, Tokyo Electron has been rising through the ranks for some time. It's passed up name brands that everybody knows, like Sony, Mitsubishi, of course, Nintendo, Honda. And as of this writing, recording, Tokyo Electron has been flipping back and forth between the number 3 and number 4 spot, with Keyence trail just behind Mitsubishi UFJ Financial Group and, of course, Toyota, Japan's most valuable business. So, what exactly is Tokyo Electron's claim to fame? It is part of the Fab Five, the five semiconductor manufacturing equipment makers that nearly 70% of the entire chip making industry have to go through to fill a fab with the needed tech and machines to make chips. And those other four companies in the Fab Five are, of course, ASML, based in the Netherlands. And then in the US, we have Applied Materials, Lam Research, and KLA Corp. And of course, besides the Fab Five, the other reason Tokyo Electron has risen to fame is, for the first time since 1989, the Nikkei 225 index, Japan's primary stock market index, re-achieved all-time highs. It's been an absolutely brutal run since then. Way to go to our fellow investors over in Japan, sticking it out. But you re-achieved new all-time highs, and Tokyo Electron most definitely helped get it back to that point.
How did Tokyo Electron get into this Fab Five? Japan used to rule the chip world in the 1980s and early 1990s. Tokyo Electron went from a trading company to an equipment manufacturer during this time. If you still haven't read Chip War by Chris Miller yet, it's a must read. There's a great historical recap of Japan's rise and fall. But Tokyo Electron has kept chugging along, especially in the last decade and a half. Even as Japan's actual manufacturing capacity has seen better days, especially in that leading edge logic and memory chips, Tokyo Electron is still very much a key player in this space. Looking at this chart provided by ASML, you can see Japan has a very small slice of lithography purchases, just 2% in 2023 and 4% in 2022. Tokyo Electron was going to merge with another company in the Fab Five, Applied Materials, back in 2013 via a $10 billion all-stock offering from Applied Materials. That new entity, which would have been called Iteris, would have had dual headquarters in Tokyo and Santa Clara, California, but incorporated in the Netherlands, which is where ASML is located. The U.S. Department of Justice shot that down, and neither company has been worse for wear since. Tokyo Electron is still on the rise as Japan's efforts to rebuild its chip-making empire get a post-pandemic supply chain and nationalism-fueled boost. Japan's government is doling out a lot of cash and tax incentives, and the world wants more localized manufacturing to avoid what happened back in 2020 to 2022 during the pandemic. Japan has been making a comeback, exhibiting relative outperformance in chips in 2023, as end market sales fell only 3% compared to much steeper declines in other geographies. Japan's automotive and other manufacturing industries are hungry, especially for homegrown power chips. And as Nick mentioned previously, Tokyo Electron stock has greatly outperformed Japan's Nikkei stock index by a very wide margin in the last decade and a half. A 3-for-1 stock split will take place on April 1st, 2024. Let's talk about what Tokyo Electron's specialty is and where it is in the semiconductor industry flow.
Right. Yes. So, as part of the Fab Five, company makes up that critical choke point in the semiconductor industry in fab and chip packaging equipment. You can see it right there in the middle. Key supplier to integrated device manufacturers like Intel and Texas Instruments, third-party chip fabs, and contract manufacturers like, of course, TSMC. And you can see from this chart, the one on the left, you can see Tokyo Electron and their market share by different equipment types for wafer fabs. You can see them in yellow. making up a majority share of lots of parts of the wafer patterning process steps. Those are the manufacturing processes that craft the tiny microscopic features that eventually become chips. And Tokyo Electron would, as you can see, would have been very complementary to Applied Materials if they had merged. Applied Materials pictured there in blue. And the closest competitor to Tokyo Electron is Lam Research, which is pictured in green. We'll come back to this in just a moment, but you can see Tokyo Electron's leading market share in track and cleaning equipment, in deposition equipment, etch, and a little bit of thermal machines used in the preparation process of those wafers. In addition to actual wafer manufacturing for the patterning steps, which Tokyo Electron calls SPE, the company also has a very small segment dedicated to similar equipment used in manufacturing flat panel displays, or FPDs. This equipment is primarily sold to the likes of Samsung and LG Display, both of which are in South Korea. This is a small portion of Tokyo Electron's financials, as you can see from this chart. The flat panel display segment in green versus the primary SPE segment in blue. And in addition, you can also see the operating segment from the last couple of years. Tokyo Electron's fiscal year 2024 ends in March. So each of these fiscal years ends in March of the year listed. You can see the FPD profit margin has been steadily declining, which indicates this area is being deprioritized a bit in favor of the growing and already highly profitable SPE segment. And for reference, if you also follow Applied Materials, you also know that that company has a similar flat panel display segment too. Again, emphasizing the complementarity of the two companies if they had merged, but c'est la vie, didn't happen.
In this slide, you can see Tokyo Electron's field solution sales, which includes fab services, repair, and replacement parts. Applied Materials Applied Global Services, or AGS segment, is a more solid bet on software and other recurring revenue services versus Tokyo Electron's Field Solutions service segment. Nevertheless, when it comes to top-notch fab equipment, Tokyo Electron is a leader. You can see, much like Applied Materials, Tokyo Electron derives most of its revenue from the non-memory market versus Lam, which is squarely focused on memory chip process steps. As for specific equipment, Tokyo Electron's focus is on deposition, etch, and cleaning. You can see that in the chart here. Deposition is pre-lithography, which is laying down of chemicals, etch, post-lithography, and removal of unreacted material to reveal the patterning, and cleaning, which is the prep of the wafer before further deposition and lithography. You can see that they have products spanning the entire wafer manufacturing process. Tokyo Electron also has a bit of back-end equipment for packaging. Applied Materials has one of the broadest lineups of back-end chip packaging, which competes with fellow diversified equipment maker Lam, as well as packaging equipment specialists BE Semi and KLAC and SOFA.
Tokyo Electron is a pretty conservatively run company, not a ton of acquisitions. They did do a bit of buying and selling in the last year, but this was very minor as they fine-tune their advanced equipment to gear up for this big run-up in global manufacturing capacity of chips. That said, rather than acquisitions, the company did plow a lot of excess cash into stock buybacks in the last year during the downturn. We'll come back to this at the end of this episode, but we do expect some free cash flow in the next couple of years to kind of just go back into the balance sheet and replenish the cash and short-term investments. But in the interim, Tokyo Electron is plowing lots of money into some new manufacturing facilities to meet demand for its machines. They have this outlined very nicely on this slide. You can see R&D expenses steadily going up, as you would expect from a company like this, which is basically a solid bet on overall chip industry research and development. But you can see below the big jump in CapEx for this current fiscal year 2024, again, which ends this month in March 2024. And the reason for that is those new manufacturing facilities, which will be open in 2025. You can see the three there on the right and bottom of the pictures that they've provided. So again, maybe just to reemphasize this point one more time, you can see the company's dividend payments expected to dip this fiscal year. Cost of acquisition there in the pink part of the bar, that's actually stock buybacks, share repurchases. So in the last year, during the downturn, during the slump for the chip making industry, Tokyo Electron plowed lots of cash back into buybacks, much like they did during the downturn in 2020. So as they finish up these new manufacturing facilities, in the next couple of years, we expect Tokyo Electron to plow a lot of its excess cash back into the balance sheet to replenish that for later on.
Let's move on to Tokyo Electron's financials. Fiscal year 2024 results are down, much like for the rest of the Fab Five companies. But this next year, which will be fiscal year 2025 for Tokyo Electron, could definitely kick off the next fab equipment spending boom. The bottom is already in for Tokyo Electron, and it has been back in sequential growth for much of last year. New all-time highs for revenue and profit could come as soon as fiscal year 2025 by our estimate, which would exceed the previous high water mark for fiscal year 2023. Management does estimate that fab equipment spending will reach $100 billion worldwide in 2024, on par for the last high mark in 2022, which was the end of the chip shortage, with growth hitting new all-time highs in 2025 and beyond.
Yeah, that's right. And underpinning some of their assumptions is, of course, Casey, the word AI getting waved around like some sort of magic wand again, specifically AI server growth, a real standout. Tokyo Electron's management predicts, roughly in line with everyone else, a compound annual growth rate of AI servers at roughly 31% from 2023 to 2027. Massive growth, and they have been positioning their advanced manufacturing equipment to capture as much of that market as they can. We think that's too easy. It's too easy to just pin this to some sort of AI story, because what's really going on, again, under the surface is Japan. As global chip manufacturing ramps up, Japan in particular becoming a top location, again, for that onshoring and friendshoring. So remember that aforementioned TSMC expansion into Japan, also Rapidus, the new big advanced chip making fab startup that will begin testing new chips in 2025, expansion from Renesas, as well as other integrated device manufacturers in Japan. Lots of companies looking to ramp up Japan's domestic chip manufacturing market again. And as Japan kind of rebolsters its domestic capabilities, there's going to be a natural outlet for companies like Tokyo Electron and the other Japanese-based fab equipment providers to sell their machinery on its home turf.
The next 2 years could hold significant growth for Tokyo Electron, perhaps a 20 to 30% or more rebound in calendar year 2024 or fiscal year 2025, with operating income dialing in at 30% profit margin. You can see on this chart provided by Tokyo Electron, just in the last few quarters, sales to Japan have increased as a percentage of the total.
And again, just to hit on what is helping lift the company's next leg higher is global chip fab equipment forecasted to re-achieve all-time highs again, about 100 billion for the total market, and then continuing beyond this next year's forecast, double-digit growth expected, driven again by AI servers, and for Tokyo Electron in particular, the emerging interest in moving some of that fab capacity into Japan.
We already mentioned that 30% profit margin is possible. Free cash flow is also been holding steady during the downturn, and it could be gearing up to soar higher following the wrap up of those facility expansions in 2025.
Yeah, absolutely. So, given these growth expectations and Tokyo Electron's very high and consistent profit margins, let's talk about company valuations for a minute and stocks that we currently own and how we would approach Tokyo Electron at this particular juncture. So we're going to do a brief comparison here to Tokyo Electron's two closest peers, Applied Materials and Lam Research. We're going to exclude the lithography specialist, ASML, and the metrology specialist, KLA Corp, because Lam doesn't participate much in either of those segments. Again, most of what it does is deposition, etch, and cleaning and wafer preparation. So Applied Materials and Lam Research are the best two comparisons when we're looking at valuation. You can see in this chart we've prepared here on a trailing 12-month basis on an earnings per share, GAAP or IFRS earnings per share basis. Tokyo Electron, definitely the most expensive stock at 45x versus 24 and 36 for Applied and Lam, respectively. Same on a price to free cash flow basis, 82 times free cash flow for Tokyo Electron versus 22 and 29 for Lam Research. This is in part the last downturn in the last year and a half or so in chip equipment sales, as well as Tokyo Electron's investments in those new facilities in Japan to support new equipment manufacturing capacity. But look at on a forward basis, especially for a forward next 12-month expected free cash flow, and then comparing that to the expected growth rate for both earnings per share and free cash flow. You can see Tokyo Electron dipping all the way to just 35 times expected free cash flow as that metric recovers. And on an earnings per share basis, you can also see a big ramp up expected for Tokyo Electron versus what we think is probably market just not completely understanding yet Applied Materials' ability to continue growing in the next year or two, some more robust expectations for Lam Research, but Tokyo Electron definitely looking like, at least from the market's consensus estimates, expected to be one of the top growth plays in the fab equipment and packaging space for the next 2 years or so.
As we mentioned before, Tokyo Electron is a very financially conservative business. So we're going to show you this slide once again here, just for emphasis. We do expect Tokyo Electron's total shareholder returns to be down a bit in calendar year 2024 before rallying in 2025. But the key takeaway here is that the company has been a fantastic return of capital for shareholders.
All right, Casey, of these three, comparing Tokyo Electron to Applied Materials and Lam Research, it looks like Tokyo Electron is the standout growth play of the moment. At least it appears that it'll be the standout growth play against Lam Research. But Tokyo Electron stock comes at a premium valuation. Is it a reasonable premium?
If Tokyo Electron does indeed grow at a 20% rate for the next 2 years, it could be quite the value right now, even after the stocks rally in the last year. For us, as many of you know, our oldest chip equipment manufacturer is Applied Materials. We invested in ASML in 2022 in November, and new investments into Lam Research at the end of 2023, early 2024, as well as some active accumulation into small caps, Axcelis Technologies, and Air Test Systems. Our choice personally has to do with currency conversion issues that can crop up between the Japanese yen and US dollar that can affect the stock price. If we were looking to put some money into a new allocation into semi-manufacturing equipment, large cap, Tokyo Electron definitely looks like a top-notch company right now.
Yeah, as for the picks that you just rattled off, Lam Research, Air Test Systems, Axcelis Technologies, and of course, ASML, and our oldest one that we've owned for 6-7 years now, Applied Materials. We'll add some links in the video description on that research. But maybe final takeaway, because this is exciting times for investors in Japan and Japan's economy at large. It is becoming a top beneficiary of all the work going into diversifying the global chip supply chain. So congrats to all of you in Japan, you investors over there. that have been patient and long suffering as you wait out a final reemergence of a bull market. We think the Japanese stock index returning to all-time highs is probably just the start of a new multi-year run as Tokyo Electron and others kind of lead the way higher. I think there could be a path to this company becoming maybe Japan's second largest company, behind, of course, Toyota. I don't know, maybe even eventually surpassing Toyota and becoming kind of like maybe what ASML is to the Netherlands. Maybe Tokyo Electron becomes that for Japan. I don't know. But this company is really, really important, and not just to Japan, really the entire semiconductor industry at large and the global economy as it puts in some much needed work to diversify chip manufacturing capacity.
That's our take on Tokyo Electron. Later this week, we're going to be talking about Renesas, which is one of Japan's IDM companies in the semiconductor industry. If you have not subscribed to the channel, make sure you hit that subscribe button. If you have not taken a look at our cybersecurity manual, we completed that recently, investing in cybersecurity stocks in 2024. Link to that manual in the description. Or if you're a member on YouTube or on Ko-fi of the channel, you get those manuals on our Discord server. We'd like to encourage everybody to come back and view that video on Renesas and the secret AI war that's taking place in electronic design automation software. See you all again soon at Chipstock Investor.